Now, despite recent economic weakness, investor and economist Charles Lieberman is positioning his clients to benefit from more economic growth. Chuck is Chief Investment Officer at Advisors Capital Management, as well as a former economist with the Federal Reserve, Morgan Stanley, and Chase Bank. Chuck, welcome to The Close. Thanks for joining us today. Just talking earlier with Binky Chadha from Deutsche Bank, he's extremely bullish. It just seems tough, considering the headwinds, considering the news flow. It's all negative right now, or is that the best time to be positioned long?
Well, I don't think it really changes the underlying fundamentals. If you look at what's happened, economic growth in the U.S. has slowed down a little bit. A lot of that is driven by supply chain disruptions with the stuff that happened in Japan. So GDP is a measure of production. Production is a little bit weaker, so as we measure it, and we measure production an awful lot, we see it in the surveys of the purchasing managers, we see it in industrial production, we see it in durable goods orders. All of that stuff is a bit weaker. It shows up in GDP. That's yet to be reported, but we'll see a little bit more weakness. But the underlying demand is actually quite good. Job growth is quite good. Consumer spending is quite good. So the drivers of the economy are actually pretty healthy, and after a little bit of a slowdown, I expect to pick up once again.
How does the end of QE2 affect all this? I mean,
very little. Very little. It's
even in commodities prices?
It's not exactly a surprise. I mean, while the previous guest was speaking, I was thinking this is the second annual May Greece sell-off. At some point, it gets boring. We start to recognize that Greece has a financial problem. We finally discount it. How many times do we have to discount it? Greece is known to be a problem. They're likely to have a soft restructuring. That is coming. Recognize it.
Well, the economic summit at Jackson Hole, now famous in Fed watcher circles, is coming up. Do we hear anything from the chairman about QE3? Is there any reason to believe we're going to get more stimulus here? It seems that the Fed, at least the members we've been hearing from recently, Charles Evans, I'm thinking of, is really pretty dovish.
Right. He's certainly one of the more dovish members of the Federal Reserve. But the fact of the matter is that as the economy produces more jobs, as the unemployment rate comes down, there was probably a greater risk that the Fed would terminate QE2 early than go to a QE3. So my thinking is that they let it expire right on schedule, as they have stated, and thereafter they just watch it and wait for a timely time to start jacking rates up or to start withdrawing some of the excess liquidity that they put in the system.
Of course, the dual mandate focused on inflation and job creation, two key elements for consumers. You talk about consumer spending. Sheila's been looking at consumer stocks here. Sheila, what do you got for us?
Well, Matt, it's really a perfect day to look at consumer stocks, particularly the consumer discretionary names, because they are taking a beating today. So particularly the retailers, you know, we've talked a lot about Gap, but it's also Aéropostale and Taylor, all down today. And, you know, it's not just today, though. This is a trend we have been seeing for the past few months. Consumer discretionary stocks did outperform the staples in the first half of the year, but what we've seen in the past few months is a reversal of that trend. In fact, consumer staple stocks now hitting two highs. Charles, I want to ask you about these stocks because I know one of the reasons you like consumer discretionary names is because of leverage. But the bottom line is leverage doesn't work if you can't get the consumer back and add to the top line. You know, we have a lot of things working against the consumer right now. We have higher gas prices, higher inflation. So lots of worries there. Are you still liking the consumer discretionary names, or is the beta trade maybe over?
I think you have to play the consumer trade. First of all, jobs are picking up at an accelerating rate. We've produced about 700,000 jobs in the last 3 months. That's a lot more jobs. It's a lot more income. It's a lot more spending power for consumers. We're going to get a personal income report very shortly, early next week. That'll show a good-sized gain in household income yet again. So consumers have the ability to spend, and in fact, they are spending. The Gap story is unique to Gap. They have some problems, but the rest of the retailing space has actually been doing pretty well. Retail sales are pretty good, so I don't see that consumers' discretionary spending is weakening at all. In fact, airline travel and hotel reports are all very strong, and that's really discretionary, and that's another great example of how the consumer is coming back.
Hey, Chuck, but at the same time, it's Julie here. At the same time, you know, you do have Gap maybe as a unique story, but a lot of these companies have been complaining about the higher cotton costs, higher oil costs, and even when you look at the hotels and the airlines, I mean, sure, some of them have recovered somewhat as oil prices have backed off, but if the oil prices go up again, the stocks are going to come right back down again. So
Absolutely.
Isn't that a pretty risky proposition?
Well, There are no riskless trades. There are no riskless investments. This is not that kind of business. Higher oil prices are a problem for these parts of the economy, but consumer spending increased even with the rise in oil prices. There hasn't been a fall off in demand for travel, for example, even with higher airline ticket prices, with higher hotel costs. So yes, it takes a little of the steam out of the consumer, but the consumer doesn't reverse. And the underlying trend is still one of a very definite improvement. It's driven by jobs first and foremost. That's the powerful driver, and that's more than enough to overcome some upward increase in oil prices.
You know, Julie, talking about airlines, but I'm drawn to Royal Caribbean here, the cruise liner, because of some of the examples that you gave us about your investment strategy here. Mm-hmm. It's going to cost more for Royal Caribbean if prices go up, but they're going to have to pay that money whether they have a lot of customers or a few customers, right? What's your strategy here as far as, for example, Royal Caribbean versus Procter & Gamble? Well,
Royal Caribbean in particular has actually hedged about 60% of its fuel costs. So they're somewhat insulated from the rise in oil prices. But the real benefit is an incremental passenger on a ship is virtually pure profit because they're running the ship anyway. So virtually the entire revenue increase lands on the bottom line.
Well, this is your point, right? Oil aside, just so people can think about this, right. If they lose a customer, they still have to pay the same price to run the ship.
Exactly.
If they get a customer, it's just more money.
That's right. So there's tremendous operating leverage in that business. Same thing with an airline. If they fly a plane, if they pick up one more passenger, it's all incremental revenue. The incremental cost is negligible. So incremental business is very, very profitable. Decremental business is very, very painful. So when you're in a recovery and more people are traveling, and in fact more people are traveling, a lot more people are traveling, the impact on these companies in terms of profitability is enormous, and you can see that in the reports. Go back a couple of years, Royal Caribbean reported earnings of 75 cents. Next year, they're likely to come in close to $4. So the numbers are very powerful, and it really drives the stock prices.
Well, and your point with Procter & Gamble is that, or with staples like Procter & Gamble, we're going to brush our teeth in a recession, we're going to brush our teeth in a recovery, and we're not going to brush our teeth more in a recovery.
Exactly right. When there's a recovery, you don't go out and brush your teeth an extra time every day. You don't wash your clothes an extra time every week. You don't
wear more deodorant.
Wear more deodorant.
Maybe even less in the recovery.
And
less pressure.
You don't use more toilet paper. Keep in the same vein. But the fact of the matter is, consumer staples are used regardless. They hold up better in a recession. They don't recover. There isn't room for recovery in an expansion.
Got it. Hey, Chuck, thanks so much for joining us.
Thank you.
Interesting stuff. Chuck Lieberman there from Advisors Capital Management.